trading psychology, mistakes, killing your profits. Most Forex traders don't lose money because their strategy is bad. They lose money because their mindset is untrained. You can have the best indicators, the cleanest charts, and the most accurate strategy in the world, yet still lose consistently if your psychology is broken. Trading is not a technical game. It is a mental game disguised as a technical one. And today we're breaking down the trading psychology mistakes that silently destroy profits, especially in Forex. Mistake 1. Trading with the need to be right. One of the most dangerous mindsets in Forex trading is the need to be right. Many traders don't care about profitability. They care about winning the argument with the market. They enter trades to prove something. They hold losing positions because closing them feels like admitting failure. They move stop losses because they know the market will turn. But the market doesn't care about your ego. Professional traders don't ask, "Am I right?" They ask, "Am I managing risk correctly?" In Forex, being wrong is normal. Staying wrong is expensive. The moment you stop trying to be right and start focusing on risk control, your trading begins to change. Mistake 2. Emotional attachment to money. Another major psychology killer is emotional attachment to money. When every trade feels like survival, you cannot trade objectively. If losing $50 feels painful, you will. Close winners too early, hold losers too long, hesitate on good setups, overreact to small drawdowns. Professional traders see money as numbers, not emotions. They know losses are business expenses, not personal attacks. If you feel fear when placing a trade, it means your position size is too big. Forex rewards calm execution, not emotional intensity. Mistake 3. Overtrading from boredom or revenge. Many traders don't lose because of bad setups. They lose because they trade when they shouldn't be trading. Boredom trading, revenge trading, impulse trading. After a loss, the ego wants recovery. After a win, confidence turns into greed. So traders enter random positions outside their plan just to feel something. But every unnecessary trade increases exposure to randomness. Professional traders are comfortable doing nothing. They wait, they observe, they execute only when conditions align. In Forex, patience is not optional. It is a survival skill. Mistake 4. No clear trading plan. Trading without a plan is like driving without a destination. Many traders say they have a strategy, but they don't have rules. They don't know why they entered, where they exit, how much they risk, when they stop trading. So emotions take control. A solid trading plan removes decision-making during execution. When rules are clear, psychology becomes easier. The market becomes data, not drama. If you're constantly confused while trading, it's not the market, it's your lack of structure. Mistake 5. Unrealistic expectations. Social media has destroyed trading psychology. People expect daily profits, 100% win rates, fast account growth. Forex doesn't work that way. Professional traders focus on consistency, not excitement. They understand that losses are part of the game. Flat days are normal, growth is slow and boring. Unrealistic expectations lead to over-leveraging, over-trading, strategy hopping. The market rewards patience, not impatience. Mistake 6. Strategy hopping one losing streak, and traders abandon their system. They jump from indicators, strategies, time frames, mentors. But consistency doesn't come from the strategy alone. It comes from mastery through repetition. Every strategy has losing periods. If you never stay long enough to understand drawdowns, you will never become profitable. Forex rewards depth, not variety. Mistake 7. Fear of missing out. FOMO. FOMO causes traders to chase price. They see big candles and jump in late. They enter without confirmation. They ignore their rules. By the time they enter, the move is already exhausted. Professional traders don't chase. They let opportunities come to them. There will always be another trade. Missing a trade is better than forcing one. Mistake 8. Poor risk management. You can be wrong half the time and still be profitable, but only if risk is controlled. Many traders risk too much per trade. Ignore drawdown limits. Don't calculate position size. This turns normal losses into account killers. Risk management protects psychology. When risk is small, emotions stay calm. When emotions are calm, execution improves. Mistake 9. Trading without reviewing performance. Most traders repeat the same mistakes because they never review. They don't journal. They don't analyze losses. They don't track emotions. So the same patterns repeat. Professional traders treat trading like a business. They review weekly. They identify mistakes. They adjust behavior. Growth comes from feedback. Mistake 10. Identity-based failure. The final and deepest psychology mistake is identity. Many traders identify as, I'm a losing trader. I always blow accounts. I'm not disciplined. And identity shapes behavior. Profitable traders don't just trade differently. They think differently. They see themselves as risk managers, process-focused, long-term players. Once identity shifts, behavior follows. Final thoughts. Forex trading is simple, but it is not easy. The charts are easy to learn. Your mind is harder to master. Most traders search for better indicators. Few work on emotional control, and that is why most fail. Fix your psychology, and strategy becomes easier. Ignore psychology, and no strategy will save you. If you like this video, kindly like, subscribe, and comment.